Silver is just becoming, more mainstream and not gold. And I think that's really what we needed. And that's what I think ultimately will take silver to triple digits, in the 300 range. I don't know how long it's going to take. It took me 16 years to be right, or 14 years, I guess, to be right on my triple digit prediction. So I'm not going to tell you when I think I'm going to see much higher prices, but I do think it'll happen.
Global electrification and next-generation tech are pushing raw material markets toward an inevitable supply reckoning. As industrial consumption reaches record highs, physical supply deficits can no longer be masked by short-term paper trading mechanics. Keithneumeyer, a veteran mining authority and First Majestic Silver CEO, contends that silver is no longer a simple speculative metal, but the critical physical glue holding together solar technology, nuclear power plants, and artificial intelligence hardware. With global annual mining production flatlining between 825 and 850 million ounces for a decade, industrial consumption is fast exhausting available physical reserves. From an independent analytical standpoint, when an essential, non-substitutable commodity hits a severe structural deficit, an aggressive revaluation becomes mathematically unavoidable. Despite temporary paper market interventions, silver is predicted to shatter previous price ceilings and surge into the triple-digit range, eventually reaching the $200 to $300 range as physical scarcity overrides paper market manipulation. Now, we present the clips from Keith's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I was wrong for 14 years. It took a lot longer than I expected it was going to take, and it was really based on supply-demand fundamentals. When I put the company together back in 2002, silver was trading around $5 an ounce, and I looked at all my buddies buying cell phones and everyone buying computers, and I came from a copper company. I left a big copper company in 2000 that I put together in 1992, and so I'm kind of already in that headspace as being a supply-demand guy and loving copper. I didn't want to be a gold guy, so there's too many players in the gold space. So silver was a very unique, metal to me. It was a huge supply-demand fundamentals as far as I was concerned. I predicted $50 silver when I put the company together, and I was right. It took, again, that was 9 years it took to get there, but it collapsed, as we all know, down to around the 12 range, and then it's kind of stayed, in the trading range for a bit. But we saw industries continually gobble up the metal, industry after industry, whether it's the photocells or electrovoltaics or computers or now AI and now nuclear energy. A big driver, as we go through this new nuclear renaissance on a worldwide basis. And, just simply as we, electrify the planet. And, I came up with the phrase, copper's the highway, silver's the glue. Without silver, nothing works. So, even this call today would not work without silver. So, people are starting to understand it. And when the U.S., called silver a critical mineral in middle of 2025, that was really kind of the beginning of the bull run. And I think a lot of institutions, a lot of investors woke up because, historically, and because you've been around this space for a long time, people tend to call silver the poor man's gold. And I've always looked at them as totally different metals. I look at gold as being money. I look at silver as being a strategic metal. And I called silver strategic years and years ago. I forget the year I brought that or made that phrase up, but now the U.S. government calls it critical. Canada is now going through their federal review on metals. They're supposed to be published something in early 2027, I understand, and there's a move there to get silver put on the Canadian list. Obviously China views silver as a critical metal as well. So silver is just becoming more mainstream and not gold. And I think that's really what we needed. And that's what I think ultimately will take silver to triple digits, in the 300 range. I don't know how long it's going to take. It took me 16 years to be right, or 14 years, I guess, to be right on my triple digit prediction. So I'm not going to tell you when I think I'm going to see much higher prices, but I do think it'll happen. I think There was a lot of industrial buying as well that came into silver, because I think when the government did come out and say, silver is a critical mineral, I think that it probably made some industries nervous, and because that was probably the last thing they wanted the government to say. So, there was, some initial buying that came in commercially. We were contacted on a number of occasions ourselves during that time frame. And then, once the move started to happen, the institutional money started coming in. That was that big run, on the long side, from, call it, October-ish to, December. And then really after that, in come January, it was profit taking and short covering. So that final move from really kind of the $90 range to 120, call it, that was all short covering, and there was a lot of pain out there. A lot of banks were losing money. A lot of institutions were losing money on the short side. And then, once the buying ended, everything, as we know in the markets, what's called, by traders is buying exhaustion, where you just, there's just no buyers left, and you do run out of buyers, and just normal fact of how the markets work. And when that did happen, obviously the big funds out there, can recognize that, because they follow this stuff very, very closely, and they just whack the market, and within a couple of days. And this is the paper market. This is not the physical market. Physical market did not change. It remained in tightness it's even tight today. But they got regained control of the paper market, and they remain in control today. And unfortunately, the market, I'm not saying, metals, just the market, it's all sentiment driven, right? And, I was listening to a banker today talking about AI, and, he's saying, he's quite a sophisticated fellow, that, AI is going to be, have 10 times more impact on the world, or, the human race, than the internet did, when it was brought in, in the early 2000s. And, efficiencies will go up, income levels will go up, so on and so forth. We don't want to talk about AI. Well, I should mention that, with silver is necessary in AI, so that's a good thing. But, it's just, the markets change according to sentiment. Right now, you see the Korean market down 7% the other day because the AI bubble has, got a little bit out of hand. Just because the market's down 7%, it doesn't mean that AI industry is dead. It just means that buyer exhaustion happened, like it did at silver, $120, and there's just no more money left. I just saw Google's capex for 2026. It was 336 or 236 billion? I think it was $336 billion being spent on AI in 2026. That's a staggering number. So it doesn't really matter what happens to, Google stock. That investment is going to be made, but they're not going to get a payback for that for 5 years, or 3 to 5 years. So in the meantime, their stock can go all over the place, and then they get paid later. Just like what happens, in our industry. The metal flies all over the place, but we've got 1 billion ounces of silver in the ground, over our assets. We're not going to mine it all today. So today we'll mine some at $50, $60 an ounce. In January we're mining at $100 an ounce. 2-3 years ago we'll be mining it at hopefully $200 or $300 an ounce. But it's just all sentiment. And right now there's a bit of a negative trade on gold. I'm seeing more and more people saying gold's going to 3,500. Silver's going to 40. And these are people that 6 months ago, same people were saying silver's going to 150, 170, gold's going to 7,000. Same people. It just, people follow trends, and it's easier to say something's going up when it's going up, and it's easier to say something's going down when it's going down.
Central banks and tech conglomerates are fundamentally altering precious metal market dynamics behind the scenes. Central banking institutions now absorb over 50% of global gold output, establishing an unbreakable floor beneath hard assets. Simultaneously, massive capital commitments such as tech giants spending over $300 billion on artificial intelligence in 2026 alone ensure exponential growth in raw material consumption. What retail traders often overlook is the massive divergence between paper futures contracts and physical supply chains. While paper markets experience temporary buying exhaustion, physical inventories remain severely constrained. From an analytical perspective, holding tangible assets during periods of fiat expansion and physical scarcity provides the ultimate hedge against paper market manipulation. This structural squeeze suggests that mining operations are predicted to sell physical output at $200 to $300 per ounce over the next 2 to 3 years. Now, let's get back to the interview.
You look at the 10-year chart, and it's available on the Silver Institute's website. Actually, you can look at our website, and if you go to First Majestic's corporate presentation, you'll see a chart on second or third or fourth page of the presentation, and it shows you 10 years. And silver productions fluctuated in 2016. So the mining sector produced 880 million ounces that year. During COVID, 2020, it dropped to 780 million ounces. Today, it's 830 million ounces. So if it's basically flatlined for 10 years. It's, anywhere between, 825 to 850, call it, every year, same as it, and it's not going to change. And there's lots of reasons why, if you want to talk, China, much of the Middle East, much of Asia, Russia up until, the current conflicts, we're big buyers of gold and many have continued to buy gold. And India, China, continually buy vast amounts of gold. So, that's created not only a bid in the industry, like a bid on the price of the metal, because they're consuming. I saw some numbers that it's 30% of annual production was purchased by the Chinese, and so far to date in 2026. Whether that's a correct number or not, it's a number I did read. So, that's a lot of silver, a lot of gold, going to one buyer. And if you add up all the other buyers around the world, and they're all central banks, that number can easily be north of 50% of the gold just going into central banks. And that's pretty interesting. That did not exist a decade ago. So, that creates a floor, in the current price of gold. And then the upside, of course, is other things like investors get excited, investors that want to put gold away, in permanent storage, for protecting their net worth, their family net worth, become buyers, and we're seeing that. So, yeah, I think to your question, it's already happening. What we call NAFTA over here. Which is a trade agreement between the United States, Canada, and Mexico. Under the current administration, they don't seem to think it's worth the paper it's written on, but nevertheless, it does protect, industry in North America to some degree. And when there was some rumors, I guess, a year ago or maybe longer now, that there might be a tariff put on silver and gold, that was quickly rebuffed, because that did show up in the internet, and there was some posts I saw on X about that topic. Yeah. And within days of that, the U.S. government came out and said, no, we're not tariffing gold or silver. Right. So, that's I would have been surprised if they would have done that, because, the United States is a huge importer of silver. They don't currently produce enough silver in the U.S. to actually feed their industry. They've got a lot of window manufacturing, microwave ovens, freezers, you name it. The U.S. produces a lot of stuff that requires silver. And so for them to put a tariff on it would just be shooting themselves in the foot. Well, I think that's one of the reasons why gold prices have come down. I think that, with, what I'm hearing, over there, and, I know people that have moved into that region of the world, from Europe, for example, going to a better climate, potentially a better tax jurisdiction, and they moved their families, and they bought real estate, over the last several years, and now they kind of regret it. and the revenue is not coming into those regions as it used to. The investment is pretty well dead, and the tourism industry is pretty well dead. So there's a lot less income coming into those countries now, and they're selling gold, to make up for that difference.
Market sentiment is notoriously fickle, causing retail investors to chase trends at cyclical tops while panicking during routine paper shakeouts. Mainstream commentators routinely swing from extreme bullishness to doom and gloom forecasts, ignoring the underlying physical supply metrics. In truth, annual silver mine output has flatlined between 825 and 850 million ounces for over 10 years, failing to keep pace with accelerating industrial demand. Furthermore, critical mineral designations across North America and Asia highlight how vulnerable national infrastructure has become to physical resource shortages. From an independent macro perspective, paper derivatives can temporarily suppress prices, but they cannot manufacture physical metal out of thin air. When real-world industrial consumption far outstrips mine production, market forces inevitably force a violent revaluation. Industry models predict silver climbing into triple digits between $200 and $300 per ounce, unlocking massive value for physical asset holders. Positioning early in real assets before paper markets catch up remains the premier strategy for long-term wealth preservation. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.